Good morning, everyone. This is Kathy. If you can hear my voice, see my screen, please let me know. Thank you, Steve. Just give me 1 second. I was trying to look for something that I want to show you guys on a seasonality basis. In the meantime, while we're kind of waiting, I would love for all of you to tell me where you are tuning in from, and where you are coming in, whether you are coming in from the US, from another part of the world. I would love to hear that. Okay, I think I have what I want to show you. And let me go ahead and share my screen. Give me 1 second. Let me get organized here. Okay, I think that should be sharing my screen right now. Hello, Surinder from London, Quantum from Panama. Yes, we will be talking about gold this morning. Mark from South Africa, Steve from US. Good morning to all of you. Okay, so I have the seasonality chart that I want to show you. So just give me 1 second. And we will get organized. Hello, everyone, for joining me on my Monday. Kathy's Caffeinated Market Buzz is my favorite time of the week to talk to all of you and to go over everything that could transpire in the week ahead, particularly when it's the start of the month. That's when we really get to talk about everything that could happen in this month. So let's kick off by talking about, what is kind of the landscape for the major currencies. And then we'll talk about seasonality, and then we'll go in the calendar, and then we'll look at technicals and cover gold along the way. So yes, we will be talking about gold. So there is no doubt that this week we have the US dollar and US markets and US data front and center. Today at 10 o'clock, we have the ISM PMI manufacturing report. Tomorrow, we have the JOLTS report. Now, the JOLTS is not traditionally one of the most market-moving releases, but lately, with such a big focus on the labor market and such a big focus on Friday's non-farm payrolls report, the JOLTS has taken more significance than usual. On Wednesday, we have the OPEC meeting. On Thursday, Fed Chairman Powell is speaking again. And then on Friday, we have the non-farm payrolls report, of course. That's going to be very important. We also have ISM services on the calendar. So that's going to be significant because the leading indicator for non-farm payrolls, along with ADP, Challenger Grade Christmas, jobless claims, all of those would be fairly important. On top of all this, that is definitely worth watching, is that we have, a number, I think it's like 14 Fed speakers this week, 14 Fed speaking events this week. And that is very important because because the messages that we're getting from the Federal Reserve is diverging from what is being shown in the dot plot. And so if you recall, the dot plot is showing 3 interest rate cuts by the Federal Reserve this year. And when we had the Federal Reserve meeting, the dollar did end up selling off. Stocks, extended their gains because everyone thought that, all of this would basically mean that, interest rates would remain low for longer. But what it ended up happening was that last week, Fed President Waller and then later Fed Chairman Powell basically came out and said, wait a minute, we're not in a rush to lower interest rates. And when that happened, it kind of halted the slide in the dollar. And it didn't really affect stocks all that much, which ended last week pretty much at record highs. But, it did affect the dollar. And that's what we walk into this week with, because if we get strong non-farm payrolls and the jobs number in the U.S. is expected to be above 200,000 once again, and if it comes out above 200,000, that would be, basically reflective of, ongoing strength in the economy, because this is the 4th straight month that we've seen job growth above 200,000. And if we get, decent ISM manufacturing and services report, the dollar could retain its bid. And we could see, further losses in euro, maybe further losses in sterling, and quite a bit of struggle for the Bank of Japan. Many people are saying that and we're skipping over to the yen, just to talk about that briefly. Many people say that the Bank of Japan or the Japanese government missed their chance to intervene in the currency over the Easter holiday, because typically, when there's less liquidity holiday, there is room for, exaggerated moves because there's less participants. They really could have got a lot bang for their buck, but they missed their opportunity. And given that they've missed their opportunity, this is obviously problematic, because now if the jobs report comes in strong, that's going to put more upside pressure on the dollar and downside pressure in the Japanese yen, really, making their struggle with a weak currency even more difficult to reverse. So right now I'm neutral dollars, and the reason for that is because in terms of the dollar itself, we are seeing mostly better data since the last Fed meeting, and the latest comments we've heard from Powell as well as Waller indicates that they are not in a rush to lower interest rates, and so maybe it could be July instead of June. And so all of that tells me that everyone's waiting for NFPs. And even though ISMs are very important and they'll give us some very good guide into non-farm payrolls, they're basically waiting for incoming data to decide what to do next. And that is going to make it a tough trade for the dollar. So we're going to use our technicals to give us a guide, because there's reasons for it to go up, there's reasons for it to go down. And when that happens in the fundamental basis, that's when we can lean on the technicals a little bit more. I am euro bearish. We've had a string of weaker Eurozone data, and it is widely believed that the ECB is going to lower, well, it is widely thought that the ECB is going to lower interest rates, or could lower interest rates before the Federal Reserve. And if that's the case, and they end up lowering interest rates before the Federal Reserve, that is widely bearish for the euro. The main report for the Eurozone this week is going to be the the Eurozone inflation report on Wednesday. And the Eurozone inflation report is expected to come in weak. If it does come in weak, that could certainly drive the euro lower. And that is the greatest risk for the ECB, because if we do get weaker inflation data, that could send euro lower and kind of reinforce everyone's belief that the ECB could lower interest rates before the Fed. And I posted something on my tweet deck. I guess I didn't. Maybe I posted it earlier, but it's on one of my favorite Twitter channels, which is V Patel FX. Let me show you this. It's a little bit old in terms of chart because it's last week, but and I like his stuff a lot. Right here. This shows you, this is a little hard to read, but you can see here, European central banks are and will cut rates before the Fed. And this shows you the futures contracts of the interest rate futures for each of these central banks. And euro dollar is at, the red line. And it shows that, there's talk of a May BOE cut. That's way too aggressive. But the ECB could technically, based upon this, lower interest rates before the Fed in June, especially since the Fed is kind of, pushing against the June and still keeping July in play. And that is another reason why I think the euro could remain bearish. So I like V Patel FX a lot. He puts together a lot of really great charts. Like this stuff is really great, kind of which Fed presidents were favoring more or less rate cuts, and just lots of really good information on his Twitter feed. So I definitely recommend that you follow that. So going back to this, I'm bearish euros. I think the inflation data is going to come in softer. I'm bearish pounds. We don't have much in the way of UK data this week. It's mostly a focus on US data and that Eurozone release and also revisions to Eurozone PMIs and UK PMIs, but overall UK data has basically been weaker. And as you saw from V Patel FX's post, the market is boosting its chances of a summer interest rate cut from the UK. So I'm bearish pounds. I'm neutral Aussie because we had that robust Australian jobs report, but the RBA has grown a little less hawkish and a little bit more dovish by dropping their tightening bias. And data from Australia has been kind of weakening, although overnight we had stronger Chinese PMI. So I'm kind of neutral Aussies at this stage. CAD, I'm also neutral because with Canada, if you sometimes with these cards, you can click on them and it says that GDP beat, but CPI was weaker and retail sales is negative. This week is a very important week for Canada, just like it is a very important week for the US. We have Canadian trade data, the IV PMI report, the jobs report. And so those are all obviously very significant releases, not only for the loonie, but also for the Bank of Canada. Last week, we had a last month, we had a very, very strong Canadian jobs growth, 40,000, blew out the park in expectations. And this month, the jobs report is expected to be softer. I think CAD should be trading lower, but these are really big numbers, could definitely turn the tide around. I'm leaning towards neutral bearish CAD. I'm bearish Kiwi. With Kiwi, we've seen weakness in business confidence, and the country fell into a technical recession. Kiwi is underperforming today. And I think that even though RBNZ is probably going to be one of the last central banks to lower interest rates, data is starting to turn negative. And for the most part, the market is definitely getting a little less positive on everything, especially with the Kiwi. And then Swiss franc. With the Swiss franc, I'm bearish. SNB was one of the first to lower interest rates, says more could come. There's nothing going on for Swissy this week, but I remain bearish Swissies against most of the major currencies. The Japanese yen. Now, with the Japanese yen, as I started to talk earlier, the BOJ missed really good opportunity to intervene over Easter weekend, where markets are on holiday, low liquidity. They were open on Friday. They could have intervened. They did not. And now they're looking at the possibility of stronger non-farm payrolls on Friday. And if we get a good jobs report, it's going to be really tough for them because the market's going to be bidding up dollars and they're going to be fighting a losing battle. And also, April, on a seasonality basis, has to be one of the strongest months for, and I wonder if I actually posted this. I think I may have, I'm not sure. April is one of the strongest months for the dollar versus the yen. And it's one of the weakest, here we go. April is one of the weakest months for the Japanese yen. This is seasonal trends in Japanese yen since 2004. So they could, if the NFP report comes in strong, they're going to be fighting a losing battle between the stronger dollar and the weaker yen on a seasonality basis. Speaking of seasonality, this is why I wanted to show you. This shows you the Dow, the NASDAQ, the S&P, and what they have performed since 1950, NASDAQ to 73, in the month of April. And you can see on an average basis, April and November are the strongest months for stocks. So April, on a seasonality basis, one of the strongest months for stocks. Stocks are obviously at very elevated levels, but if we get a good jobs number and, you know, the interest rates, I guess, won't be increased anytime soon, there is a case for ongoing strength in stocks this month, which would be positive for dollar yen. So even though stocks are at record highs, they could continue to rise in the month of April on a seasonality basis, because April is traditionally really good month for dollar yen, or a really weak month for the yen, and a really, really good month for stocks. So I don't always show seasonality numbers because oftentimes it don't matter. Like May and June, aside from the sell-in May go away, but May and June are not, you know, really good months for stocks. Neither is February or March. They're just kind of in between. But April is. April is a good month for stocks. We'll have to revisit later on to see whether or not this is actually true at the end of April. But I definitely think it's worth talking about. And it's worth talking about how April is traditionally a very, very good month for stocks, and one that we definitely cannot ignore. What else do I want to tell you about? Let's take a look at the economic calendar. So we had on Friday Japanese data dump, which I think is important to talk about. The jobs data was weaker, the inflation data was weaker, the retail sales numbers stronger, industrial production was weaker. Overall shows, you know, ongoing weakness in Japan's economy. And then that's part of the reason why they will find it very, very difficult to continue to push forward with interest rate cuts, because the problem here is that, you know, they are indeed, you know, in this position where they can't raise interest rates aggressively. And that is why the yen is having such a hard time extending its slide after the Bank of Japan rate hike. And then ISM manufacturing is coming up later today. That is expected to be stronger. Now, with this number, I would be a little cautious because Empire State and Philly Fed survey was weaker. So I think there is definitely room for a downside surprise. We have no other data today, but we do have Fed President Cook speaking, RBA minutes later on today, inflation data from Australia. So these are fairly important. And then tomorrow we have Swiss retail sales. That's going to be interesting to watch. We also have German inflation data, which is expected to be stronger, although I think it could end up being weaker. So we'll have to keep an eye out for that. And that's because not only did the ECB lower its inflation forecast, but the input and output costs, according to the PMIs, dropped significantly. So there's risk to the downside for the German inflation data. UK has mortgage approvals, mortgage lending, not a huge market mover. We have factory orders from the US, which is expected to rebound, also not a huge market mover. Bauman, Williams, Mester, Daly, all speaking. We also have the Australian AIG group PMIs, which are worth watching. But once again, the focus is on the US dollar. For those of you that are joining late, I talked about how we have ISMs this week. We have the JOLTS data tomorrow. We have Fed Chair Powell speaking on Wednesday. A whole bunch of Fed speak. This Fed Chair Powell speaking at lunchtime. A whole bunch of Fed speak, along with the jobs report. So very much a focus on the dollar. And remember, it is Fed speak that basically, you know, kind of turned everybody's ideas around, because the Fed said 3 rate cuts this year. Then Powell said, well, no, we're not in a rush to lower interest rates. Now we have to hear from everyone else. Are they, joining in that course, supporting, resisting a rate hike, or are they not? And so that is something to pay attention to. We also have ISM services coming out later this week. And that's going to be very, very important leading indicator for non-farm payrolls. And then on the 4th, we have Swiss inflation data, very, very important. That's going to help decide whether they're going to lower interest rates again or not. We also have Eurozone PMIs. We have challenger job cuts, Canadian trade data, US trade data. All of that is important and interesting, but of course not as interesting as ISM and ADP, which came out on Wednesday. And all of this Fed speak, 18 Fed speeches this week that is worth watching. And then on Friday, that's when we get to the main events. We have revisions to Eurozone PMIs. We have German factory orders, Eurozone retail sales. The German retail sales numbers were horrendous. And so the Eurozone retail sales numbers should be stronger. And thank you, David. I'm going to update the card. It should say different GMT time because of the time change. So I'm going to change that. Thank you for letting me know. Canadian and US jobs numbers, both of which are expected to be very big market movers. And, the US jobs numbers and Canadian jobs numbers, they're both expected to be softer than the previous month, but still robust. I mean, 25 would be pretty good for Canada, and 200, anything above 200,000 would be good for the US jobs number. So that's also going to be important. And for those of you that are joining us late, I apologize. Please watch the replay. It'll be up later. I talked about how April is a very, very strong month for stocks. So even though stocks have had very, very good moves, April could still stand higher on a seasonality basis because April, November, and December are the strongest months for stocks, period. Boris will cover gold, but let me just run through the charts quickly. Euro below all of the major moving averages. On the heat map, I am bearish euros, bullish dollars. So we could still get an extension of the slide in the euro dollar, especially if all of the Fed presidents kind of push against the talk of a early rate cut. Push against, say, also reaffirm that they're not in a rush to lower interest rates. Sterling, also, below all the major moving averages, but moving averages matter. It's not a coincidence that last month's move stopped right at the 200-day SMA. That's support. If it breaks below it, we can see a more significant move lower. Dollar yen. Dollar yen remains above all the major moving averages in the consolidative zone. If you missed what I said earlier, they missed their opportunity to intervene during the Easter holidays. So now they could, still intervene, but they're, it's going to be a futile effort because, the market's still going to be holding steady ahead of non-farm payrolls. And the only way it's going to work is if we get a weak non-farm payrolls report and dollar yen falls and then they intervene, compounding the move lower. But if we get a strong non-farm payrolls report, they're going to be fighting against the forces of that and the forces of the seasonality for the yen in April, which April tends to be the weakest month for the Japanese yen. So it's going to be a battle for them. And I think this BOJ is proving to be less effective, less willing to move than the BOJ in the past. Dollar Swiss, we're bearish Swiss francs, bullish dollars. And so overall, we'll have to see. This is all going to hinge on NFPs, but I think that Swiss franc could continue to underperform. In terms of Aussie, I'm neutral Aussies, bullish dollars. It's below all of the major moving averages. And so it looks like it's still extend higher down to 64.50. Kiwi, weakest currency this morning, and in terms of support in Kiwi dollar, it's going to been quite a bit of support, 59, this congestion zone over here. That's where, I think it could find some support. And then dollar CAD, with dollar CAD, I think either CAD CPI data was weaker. We have a big week for Canada with IV PMI along with the jobs report and the trade data. I am leaning towards a bit of weakness in CAD, but oil prices have been strong. I think as long as we hold above 135, I'm a buyer of dollar CAD. If we break below 135, then we can see a more significant move lower. All right, so now I'm going to let Boris come in and talk about gold and the equity markets, and then we'll take questions.
Hi guys, hi. Let me change screens to me. Let me just make sure I get the right screen. Two, we want to go three, and we want to go over here. Make sure you guys are seeing my screen. View. Yep, cool. All right. Good morning, everybody. Thank you for the compliment. Somebody in the room, Kay, said that I look younger, or I look young, which was really nice these days. Thank you for the kind words, guys. So gold, obviously, incredibly strong move, fresh all-time highs today. Unfortunately, for our kind of a longer term signal strategy, which is Thunderbolt, we got the buy, but remember, it's a breakout strategy, and the retrace just clipped us out. So the prior trade in Thunderbolt made 63 points. Today's trade, unfortunately, clipped us out at a 19-point stop. This is a big breakout strategy with very large risk to reward ratios, so it's naturally going to not be nearly as accurate, but it's going to, when it hits really big. Bottom line in gold, from a technical point of view, in my opinion, of course, is that there's only two positions in gold you really want to take. You want to be either long or flat. I think gold is clearly in a long-term secular bull market. From a fundamental point of view, there are a couple of reasons for why I think you could make that argument. And I think the most important reason is actually sovereign debt threat, right? The key thing that almost every analyst I listen to, every macro player on Wall Street, I think is universally agrees that there is zero chance, regardless of who is president, regardless of who's going to be running the country, there's zero chance there'll be any kind of meaningful deficit reduction. We are living in a world of like 5 to 6% budget deficits in the US simply because that's what's needed to essentially keep the economy afloat. That, however, of course, creates really significant long-term structural pressures on debt servicing. Because remember, now I think we're running at around $1.4 trillion worth of interest cost itself. If you look at the US budget, it really is divided into three components: Social Security, defense, and interest costs. Everything else is just literally a footnote. Everything else is a footnote, meaning that these are the three main things that all of the budget is being spent on, and that interest rate expense is really creeping up higher. That's what I think is being expressed in the rise in gold if you're looking for a fundamental reason for it. But even whether you're looking for a fundamental reason, it's clear from a technical point of view, as I said, there's only just two trades in gold for the near term, which is up or flat. So on the longer term chart, yes.
But there are more day trades in gold. And if you're interested in learning how to trade gold on a day trading basis, we put in a link into the live stream so that you can join that. So you can, because I mean, people are probably wondering, what is that link? So that link is basically a special webinar Boris is doing tomorrow that is going to teach you how to trade gold. So make sure you register for that free webinar.
Right, exactly. And I'm just getting to the day trades, which is what I was going to tell you, which have been far more successful in the longer term trades. So this is just simply the scalper that we use every single day. And you can see that's already had today. I mean, this is just starting today. This is trading the 1 minute chart. 1, 2, 3, 4 winning trades so far in the scalping mode, and this is all scalping from the long side. And this is a strategy that I'm going to describe in minute detail, show you exactly how we traded. It's been extraordinarily productive on gold, especially because scalping is a strategy that depends on volatility. Gold has been incredibly volatile, so it's been super effective for us. We'll go through it. I'll show you exactly how we traded on gold, what hours of the day it works best, and so on and so forth. And then the other strategy, which is an intermediate strategy, sort of like we call it the big strategy. We traded usually at the beginning of the day. As you can see, as while I was talking to you, it hit its first target, and now it's hit its second target, which is right here. It made $6 or $6,000 per contract if you're trading this on either futures or a CFD contract. So very effective, I think, to orient yourself to the long side. Very effective to do it with our indicators, because these are all proprietary indicators. They're not available anywhere on TradingView except in our room. They're not even visible on TradingView, so the only way you're going to be able to get them is if you come and trade with me every single day. And if you want to find out exactly what happens in my room and how we're going to, put this, put all these indicators into practice and how we use them to both make money in our, CFD accounts and in helping to pass the prop test, which is one of the things I'm going to be talking about, is how we can. Gold is one of those incredible instruments. I'm going to talk. This is something I haven't even mentioned in the previews. Gold is one of those incredible instruments that allows you to literally pass the prop test in one single trade. And I'm going to show you exactly how to do that a whole bunch of different ways, a whole bunch of different strategies. So it's very, very exciting. I think it's really the instrument of 2024. We're going to devote a tremendous amount of focus. We have all sorts of algorithmic tools that is, robots that can auto trade this for you that are set and ready to go. And all of these strategies can be quasi auto traded as well. That is, set it and let the execution happen automatically for you. So I'll discuss all of that stuff with you guys tomorrow in my free webinar. Hopefully you'll join us. But in the meantime, as you can see, we're opening up the week. It looks like it's a relatively positive risk on week. I mean, if we look at equities, Nasdaq started up really, really high, and kind of, and that's interesting actually. And Nasdaq started gap open, right? We were gap open on the open. I actually faded this big move on the open, but then I actually thought it would hold. So to me, it's interesting that we're starting to unwind all the way down now through the 18. We just gave up the 18,500. It'll be interesting, to see just how much of a move there is. I think the turbulence in equities is really a function of the fact that more and more people are beginning to understand that there is very little interest rate relief on the packet. The other thing that I was going to sort of say about gold and equities and everything else is that on Friday, when everything was closed, we had a Good Friday, markets were closed, the PCE number came out, and it was a little bit lower than the market expected. However, hidden within PCE was something called services inflation, or I forgot what the official term for it is, but it's basically service inflation. And what that's showing is that services inflation, which is really the most important inflation right now, goods have all come down. And goods, I think, are going to even come down even further with the advent of AI and the advent of tighter supply chains and China just dumping everything that they can onto the global markets because they need to revive their own economy. So I think goods are not a problem for the global economy, but services, which is a much, much larger component of every industrialized economy, it's 70% of all US economy and 70% of almost all the OECD economies, that's becoming very sticky. People expect higher wages every single quarter. Those higher wages are translating into higher service costs. And I think everybody's feeling, we'll go to restaurants, it's now $100 for a diner dinner versus, like $50 just pre-pandemic. And I'm talking about just literally, breakfast of pancakes, eggs, and coffee for a family of four. So you're seeing that, I think, hidden embedded inflation, which means I think the Fed, my personal view is that there'll be it'll be June, one and done, unless we literally fall off the cliff economically, which I doubt is going to happen. And that means all of this underlying inflationary pressures definitely helping gold as we go forward. That's how everything ties in. And as far as stocks go, it's kind of a two-way street. Stocks actually perform quite well at the beginning of the inflationary cycles until they become so burdensome that the demand comes down. But as long as companies can keep raising rates even 0.5% higher than what their cost of goods is, which is what they're doing, their profit margins continue to grow, and that's actually positive for stocks. So just because there's inflation doesn't mean stocks are going to go down. But as you can see, I think today what you're seeing is the threat of the notion that we're only going to get one rate cut this year at best. So that's how everything shapes up. I'm going to be live trading in 10 minutes. So if those of you guys who are coming in, come join me. If you're interested in joining us, please join us at bktraders.com. And those of you who want to come and understand how to trade commodities, specifically gold and oil, both from a prop trading point of view and just from your own account point of view, I'm going to share all of my tips and tricks tomorrow night. So please come join me, free webinar. Love to see you guys there.
And otherwise, if you can't make it, just register. We'll send out the replay. And the replay of this live stream will also be posted on our YouTube channel pretty much as soon as it's done. So keep an eye out for that. Otherwise, Thank you all for joining us for our Caffeinated Market Buzz, and we will see y'all soon. We do this every single day with our BK members, and there's lots of ways to get access to all of this for free. So please take a look at all the links in our channel. Have a great day. Have a great trading week.
Or if you have any questions, email us at contact@bktraders.com. Contact@bktraders.com. Be happy to answer any questions you have. All right, guys. So we'll see you in the markets.